Hey everyone, welcome back. We're going international with our investments this time. At least that's what you sent me a bunch of stuff about and want to know more so.
Yeah.
Let's deep dive into it. And one thing that really caught my eye, free lunch. That's how Ben Felix described the potential benefits of international diversification in one of your sources, his YouTube video, right?
Yes. He's a portfolio manager, so he knows a thing or two about this stuff.
Okay, well then a free lunch? Sign me up. But is it really that simple?
Well, it's a good way to grab your attention, right?
Like,
But I think it oversimplifies things a little bit.
okay, fair enough.
The first thing you need to understand is that spreading your investments across different assets that don't all move in the same direction can be a really powerful tool.
Okay, so not putting all your eggs in one basket.
Exactly.
We've all heard that before.
Right. And there's a reason for that.
Yeah.
It's a fundamental principle of investing.
But then why not just stick with what we know? Right?
Yeah.
The U.S. stock market has been doing pretty well historically, hasn't it?
Yeah, it has, but that's where things get a little tricky.
Okay, how so?
Chasing past performance is not always the best strategy. You know, just because something has done well in the past doesn't guarantee it will continue to do so in the future.
I see. So what's the bigger picture here? What are we missing when we just focus on the U.S. market?
Think of it like a basketball team. You can't have all-star players. You need a mix of skills and strengths to win consistently.
Oh, okay. I like that analogy. So you're saying the same logic applies to investments. You need a diverse team of assets, so to speak.
Precisely. And one of the core concepts behind this idea of diversification is something called modern portfolio theory,
Okay.
developed by Harry Markowitz, a Nobel laureate in economics.
Okay, I've heard of him.
Yeah, and his theory basically says that by investing in a mix of assets that don't move in perfect sync, you can either increase your expected returns without taking on more risk,
Okay.
or reduce your risk without sacrificing returns.
Now that sounds like a free lunch.
Right. It's pretty powerful stuff.
So how does this apply to international diversification specifically?
Well, it suggests that excluding international stocks from your portfolio could be a suboptimal strategy.
Really? Even though the U.S. market has been doing so well?
Yeah. Even then, there's a model called the Capital Asset Pricing Model, or CAPM. And according to this model, in an efficient market, you want to hold a globally diversified portfolio.
Yeah.
That's how you maximize your risk-adjusted returns.
Okay. But still, the U.S. market has been the MVP for quite a while, hasn't it?
It has, but there's some research out there suggesting that part of its success could be attributed to factors other than just superior business performance.
Like what?
Well, Cliff Asness, who's a co-founder of AQR Capital Management, he's done a lot of research on this, and his findings show that a large portion of the S&P 500's outperformance could be due to rising valuations. Meaning that the price of U.S. stocks has been going up more than their earnings justify. Oh, okay. So it's not necessarily that U.S. companies are inherently better. It's just that investors are willing to pay more for their shares.
Exactly. And that's where the concept of valuation becomes really important.
Okay, I'm with you. So how does valuation play into all of this?
High valuations can actually be a hurdle to future outperformance. Think of it like buying a house.
Okay.
If you buy a house that's already overpriced, there's less room for its value to appreciate in the future.
Right, yeah. That makes sense.
Same thing with stocks. If you're buying into a market that's already expensive relative to its earnings, you might not see the same returns as you would if you invested in a market that's more reasonably priced.
Interesting. So even if a company is doing well, if its stock price is already inflated, it might not be the best investment in the long run.
Exactly. That's a key takeaway here.
Yeah.
We need to be mindful of valuations when making investment decisions, not just chase past performance.
Okay. And this applies to both U.S. and international stocks, I assume.
Absolutely. Valuations are crucial no matter where you're investing. Got it. So we've talked about the potential pitfalls of chasing past performance and the importance of valuation. But is there anything else we should be considering when thinking about the U.S. market versus international markets?
Well, there's another angle to this whole discussion that I find fascinating.
Oh, I'm intrigued. Tell me more.
The element of luck.
Luck.
Yeah, luck. It might sound strange, but some research suggests that part of the U.S. market's success could be attributed to just plain luck.
You mean like winning the lottery kind of luck?
Not exactly. More like avoiding major disasters or benefiting from investor perceptions of safety. It's like flipping a coin and getting heads 10 times in a row.
Okay.
It doesn't mean heads is guaranteed on the 11th flip.
So you're saying we can't just assume the U.S. market will keep outperforming forever. There's an element of chance involved.
Exactly. We need to be realistic about the role of luck in investing and not base our decisions solely on past performance.
Okay, I see your point. So if relying solely on the U.S. market might be a bit riskier than it seems, what does that mean for investors who are trying to make smart long-term decisions?
It highlights the importance of diversification.
Okay, back to diversification.
Exactly. And specifically, international diversification. It's about spreading your risk and potentially capturing returns in markets that are poised for growth.
So even though the U.S. market has been the star player for a while, it might be time to look at the rest of the team and consider adding some international talent to the roster.
That's a great way to put it. And that's what we'll explore in more detail as we continue this deep dive.
Sounds good. I'm ready to learn more about these international players.
Me too. Let's dive in.
So we're convinced, right? International diversification. More than just a catchy phrase. But how do we actually, put it into practice?
Right, from theory to action.
Exactly.
Well, there are a few different approaches, each with its own, pros and cons.
Okay, lay it on me. Where do we even begin?
One of the easiest ways to get started is with index funds or ETFs, exchange-traded funds.
Okay.
These funds track specific international market indices, basically baskets of stocks, representing a particular market or a sector.
So instead of picking individual international stocks, I could just buy, a share of an index fund that covers, let's say, European markets.
Exactly. Like one example is the MSCI EAF Index.
Okay.
Stands for Morgan Stanley Capital International Europe, Australasia, and Far East.
Wow, a mouthful.
It is. But it's a widely used index. It tracks stocks in developed markets outside the US and Canada.
So buying a share of an ETF that tracks the MSCI EAFE, I'd be invested in a bunch of companies across Europe, Australia, and parts of Asia, all at once.
That's right, instant diversification. And they usually have lower fees compared to actively managed funds.
Okay, less work and less cost. Sounds good to me. But wouldn't that mean I have less control over exactly which companies I own?
True. With index funds, you're buying the whole market, not individual stocks. You're riding the wave of the overall market performance.
Okay, I get it. So if I have strong feelings about specific companies, I might want to consider, picking individual stocks.
Exactly. That's option two, a more hands-on approach, building a portfolio of individual international stocks.
Sounds more adventurous, but probably a lot more work too.
It definitely is. Research is key here. You really need to understand the company, its industry, the whole 9 yards.
So not just picking a company with a cool name.
No. You need to dig deeper. Look at their financials, understand their business model, their competitive landscape.
Okay, so basically becoming an international business expert.
Well, at least somewhat knowledgeable about the companies you're investing in. And remember, valuation is always crucial.
Right, we talked about that. Don't want to overpay, even for a promising international company.
Exactly. Think of it like bargain hunting. You want to find companies that are undervalued by the market, hidden gems with growth potential.
I like the sound of that. But how do you even find these hidden gems?
It takes research, reading financial reports, understanding industry trends, looking at things like their corporate governance practices.
Their what?
Corporate governance, basically how the company is run, how transparent they are, how they treat their employees, all that stuff.
Oh, okay. So it's not just about the numbers. It's also about their values and ethics.
Yes. And of course, you want to consider their growth prospects. Are they in a growing industry? Do they have a competitive edge? Are they innovating?
So it's a lot to consider. Any tips or tools to help with all this research?
Absolutely. There are lots of reputable financial news sources, research platforms, investment communities. You can also consult a financial advisor specializing in international investing.
Okay, good to know.
Yeah.
So we've got index funds, ETFs for a more passive approach, and then stock picking for the more hands-on investors. Are there other ways to diversify internationally?
You bet. You could explore international real estate, for example.
Real estate, like actually buying property in another country.
That's one way, but it can get complicated. It requires a lot of capital.
Yeah, that's probably not for me.
Fair enough. There's another way. Investing in REITs, real estate investment trusts.
REITs?
Yep, they focus on international markets. They're companies that own and operate income-producing real estate. And you can buy shares in them just like stocks.
So instead of owning a physical property overseas, I own a piece of a company that owns a bunch of properties.
Exactly. It's a way to diversify beyond stocks and bonds.
And potentially benefit from, like, different real estate trends around the world.
Exactly. But of course, there are risks involved.
Like what?
Currency fluctuations, local regulations, political instability in some regions.
So maybe not for the faint of heart.
Haha, probably not. More of a niche investment strategy.
Okay, noted. Besides stocks and real estate, are there other things we can look at for international diversification?
Absolutely. International bonds, for instance.
Bonds. I thought those were generally considered safer, less volatile than stocks.
They can be, but just like stocks, bonds come in different flavors. Government bonds, corporate bonds, and, you guessed it, bonds issued in different countries.
Okay, so how do they fit into the international diversification picture?
By investing in international bonds, you can potentially reduce your portfolio's volatility, and you gain exposure to different interest rate environments.
Okay, I see. So if interest rates are rising in the U.S., I might find better returns in bonds from countries with lower interest rates.
That's one potential benefit. But remember, investing in international bonds also comes with that currency risk we talked about. If the U.S. dollar strengthens against the currency the bond is denominated in, your returns could be less when you convert them back to dollars.
Ah, right. Currency fluctuations. Always something to watch out for. Any other asset classes we haven't talked about yet?
Let's see. Commodities.
Commodities, like gold, oil, things like that.
Exactly. They can be a bit more exotic, but they can play a role in diversification too.
How so?
Well, they can act as a hedge against inflation. When prices rise, the value of your commodity holdings tends to go up as well.
So it's like a way to protect your purchasing power.
Precisely.
Yeah.
And because they're influenced by global supply and demand, they tend to move independently of stocks and bonds.
So they add another layer of diversification.
Exactly.
Wow, this is amazing. So many different ways to diversify internationally.
It is. And the best part is you can customize it to fit your needs and preferences. You can start small and gradually increase your exposure over time.
So there's no one-size-fits-all solution.
Nope. It's about finding what works best for you. And remember, international diversification, it's a long-term strategy. It requires patience and discipline.
Not a get-rich-quick scheme.
Definitely not. It's about riding out the ups and downs of global markets and building a portfolio that can weather different storms.
That's a great point. I think we sometimes forget about the long game when we're caught up in the day-to-day market noise.
Absolutely. It's important to keep your eyes on the prize, your long-term financial goals.
So we've covered a lot of ground here. We've talked about the why, the how, and even touched on some of the risks involved with international diversification. What comes next?
Well, in the next part of our deep dive, we'll explore those risks in more detail. We'll talk about things like currency fluctuations, political and economic risks, and what you can do to mitigate them.
Sounds good. I'm ready to dive deeper into the nitty-gritty of international investing.
Me too. Let's do it.
All right, so we've talked about all the good stuff with international diversification, but got to talk about the risks too, right? What are some of the potential downsides here?
Yeah, definitely got to be aware of those. One of the biggest ones is currency risk.
Currency risk, okay.
Yeah, so when you're investing in things priced in foreign currencies, like stocks or bonds from other countries, your returns can get affected by how those exchange rates change.
Oh, right, because the value of the dollar compared to other currencies is always fluctuating.
Exactly. So let's say you buy stock in a Japanese company, right? And at the time, one US dollar equals 150 Japanese yen.
Got it.
Now, imagine the yen weakens against the dollar.
Okay.
And now $1 buys, say, 160 yen.
Uh-huh.
Well, even if the stock price in Japan goes up, your investment could be worth less in dollars when you decide to sell it.
Because you're getting fewer dollars back for those yen.
Exactly. The change in the exchange rate kind of eats into your returns.
So it's like a tug of war between how the stock performs and how the currency is doing.
That's a great way to put it. Currency fluctuations can make things pretty volatile, especially in the short term.
Okay, but you said short term, so does that mean it's less of a problem over the long term?
Yeah, usually over longer periods, those ups and downs tend to kind of balance out.
Okay, so it's a risk, but maybe not a deal breaker, especially if I'm in it for the long haul. Anything else to watch out for?
Well, there's also political and economic risk.
Right, things can be a little less predictable in some countries.
Exactly. Some international markets might not be as stable as what we're used to in the U.S. I mean, you could have things like political upheaval, changes in regulations or economic downturns. All of those things could impact your investments.
Yeah, it's like that saying, don't put all your eggs in one basket. But in this case, the basket is a whole country.
Yeah. And that's why it's so important to do your homework, really research any country you're thinking of investing in.
So look for stable governments, good economic policies, and a good track record on, like, property rights and stuff.
Exactly. You want to make sure your investments are protected.